This is the Asia Trade. I'm Shery in Tokyo.
I'm Avril in Singapore. The top stories this hour. Asian stocks set to struggle for direction as investors weigh the Fed's policy outlook amid limited access to key economic data. October jobs and inflation numbers probably won't be released, even with the House set to vote soon on ending the record-setting U.S. government shutdown. Will be live on Capitol Hill. Plus, Jeffrey Epstein's ties to Donald Trump back in the spotlight as Democrats highlight emails suggesting the president knew of his activities.
Take a look at how we're setting up for the Asian session as we're waiting that vote in the U.S. House of Representatives to end the government shutdown. Take a look at Nikkei futures pointing to the upside. We saw Japanese stocks gaining ground in the previous session. In fact, the Topix at a record high, gaining more than 20% already this year. The Japanese yen sitting at that 154 level against the greenback. Now, we had seen significant weakness, lowest levels since February against the U.S. dollar. So the finance minister coming out and really talking about those excessive yen moves. Of course, we're on intervention watch. We haven't seen one since last summer when we saw back in July the finance ministry intervening in the markets. The offshore yuan has seen a little bit of strength against the U.S. dollar as well. We have greenback weakness. The ASX 200 at the moment in that staggered open at that 87.92 level. Of course, we'll continue to watch the latest developments around oil prices as well and those related to oil, the sectors that could potentially take a hit as we continue to see the downside pressure there as well, Avril.
Yeah, Shery, we already saw in the U.S. energy stocks underperforming as oil prices tracked lower. But we are, of course, waiting out for this vote in the House to end the U.S. government shutdown. And it's worth noting that against the backdrop of resolutions, the past 4 shutdowns, we actually saw the markets climbing. The question is how much is already being priced in by the markets. We saw the Dow hitting all-time highs, not just energy that underperformed. Tech was also pretty tepid. We did see Treasuries and gold gaining ground, though, and the Bloomberg dollar index was holding fairly steady. Now, U.S. House lawmakers meeting to vote on that bill that would end the 43-day-long government shutdown. The legislation would reopen the federal government and fund some agencies, but it could take days or weeks before normal operations resume. Let's bring in our Washington correspondent and Bloomberg Balance of Power co-anchor, Joe Matthew. Joe, really good to see you. So what is the state of play when it comes to the vote?
Well, look, we're 43 days in the making here, and it looks like just a couple of hours away from this vote actually happening. We understand around 8 p.m. Eastern time is the window that the speaker expects us to get down to actual voting following just weeks and weeks. This is the first time that House members, in some cases, have been back in Washington in more than 50 days. And to your point, this would refund the government, but only through the end of January. There are some important agencies that would be funded for the year, including Agriculture and Veterans Affairs. But as far as the rest of this goes, once they reopen the government, they'll immediately have to start negotiating on what to do next. And we have already been asking lawmakers if there's a chance we could shut down again in January or on January 30th. And that remains a distinct possibility if they don't come to terms on extending health care subsidies, which has really been the rub here between Democrats and Republicans. This, as I mentioned, would be signed tonight as well by the president, assuming this passes as planned. It does look like Speaker Johnson has the votes to finally bring this to a close.
Yeah, and as you mentioned, the Obamacare tax credits, for example, the Senate has agreed to that vote to happen. What's happening in the House? And given that timeline, what could happen next, especially as the shutdown, as the temporary funding will run out at the end of January?
Well, look, it's a very different reality here in the House. Speaker Johnson, unlike Senate Leader John Thune, has not promised a vote on this. And so Democratic lawmakers in the House are very concerned about where they stand. Negotiations are expected to take place once the government reopens, but it's unclear what they will lead to and whether it's more than a temporary extension, whether other collars or guardrails are put on this whole idea of extending premiums. But you're asking the right question. If they cannot come to terms on this, that will increase the odds of the government shutting down again at the end of February. And I could be back here the first day of February talking to you about how long that might last. The next couple of weeks are going to be incredibly important in figuring that out.
Absolutely crucial. But what's also interesting, Joe, is amid the shutdown, how this has overshadowed these calls for the release of Epstein files. Now Trump-Epstein ties are back in the spotlight.
That's for sure. The newest member of Congress, a Democrat from Arizona, Adelita Grijalva, has just been sworn in just a couple of hours ago, and she became the 218th signature on what they call a discharge petition that would force a vote on the floor, in this case, to release the Jeffrey Epstein files. We talked to, in fact, one of the lead sponsors of that discharge petition, Tim Burchett of Tennessee. The Republican says they expect a vote at the beginning of December on that, but I'll caution everybody, it does not appear that there are votes to pass it in the Senate, which would be required. And I'll remind you as well that President Trump himself would have to sign this for it to be released. So it's unlikely that there's a path there right now, but it will be important for Democrats to get Republicans on the record once this does come to a vote. Meantime, there are Epstein files being released through the Oversight Committee, and you may have seen reporting to that end today, emails written by Jeffrey Epstein that allegedly mention President Trump. So we have not heard the end of this.
Yeah, we're Washington correspondent and co-anchor Bloomberg Balance of Power Joe Matthew there, watching everything that has been happening in Washington as we await that vote. And the White House now saying that the key October economic data, including jobs and inflation reports, probably won't be released due to the government shutdown. National Economic Director Kevin Hassett also saying that the shutdown will impact this quarter's U.S. GDP reading.
For sure, it's going to have an impact on this quarter GDP. That our estimate of the White House is that each week that we were shut down is worth about $15 billion off of GDP. I think the Goldman guys have added all that up and guessed that it's between 1 and 1.5% reduction in the growth rate of GDP this quarter. So I was kind of feeling good about a 3% quarter before the shutdown. So I guess that means that you think we'd be shooting in the sort of 1.5 to 2 range now.
Let's bring in Washington Bureau Chief Margaret Collins here with the latest on this. Of course, we were expecting those numbers to come out at some point, and this longest ever government shutdown may actually lead to no data at all. What does that mean for investors and just economists trying to assess the market?
That's right, Shery. We heard from White House Press Secretary Caroline Leavitt earlier today that it's unlikely that we will see an October CPI or even an October jobs report. So that will leave a historical gap in the economic data for this year in the U.S. economy, and it will pick back up in November. One of the reasons why is because of this longest government shutdown in history. In October, the data collection was not happening in terms of government workers going out to survey employers and households about how they were doing in terms of inflation and the jobless rate. So that is something that is going to pick back up now. But as Joe was explaining, there's a lot of wheels that have to start turning again in terms of getting government workers back to work and back to doing those surveys.
On top of Hassett saying that we might not get the data, he's also saying he would accept the Fed chair job, that he wants lower rates. We're also hearing from Raphael Bostic saying he would retire by the end of February. Do we have a clearer idea of who the players on the Federal Reserve Decision-Making Committee is going to be in the first half of next year?
Well, we certainly know that we're in the home stretch on that. The administration has said they're down to a handful of top candidates, Hassett being one of them, that they are looking at to take that Fed chair role, but that Trump ultimately will be the one who picks it. Powell's seat as chair is coming up in May of 2026, so this is a really pivotal point right now. And we already have Stephen Myron, who joined the board a couple of months ago. And he's dissented now a couple of times on Fed decision days in terms of wanting a bigger cut of 50 basis points. Hassett said today he would also potentially support a 50 basis point cut. But at the same time, we have other people on the Fed board who question whether there was a need at all for a cut in this last meeting. There are risks on both sides of the Fed's mandate right now, as Fed Chair Powell has said more than once, in terms of risks to unemployment rising and risks to inflation rising again. So there's a lot of debate amongst Fed policy makers right now on the FOMC. Their next meeting will be mid-December, and as of right now, with the shutdown, looking like it will be over in the government reopening, we will expect to have at least some new economic data, even if we don't have October, that we will have some coming out in early December before that Fed meeting on December 9th and 10th.
Washington Bureau Chief Margaret Collins there with the latest from Washington as we continue to watch that U.S. House vote on the federal funding and, of course, the reopening of the U.S. government. But take a look at Drone Shield. This is a defense company trading in Australia, now falling more than 20% after the CEO sold 49.5 million Aussie dollars in shares. And remember, CEO Oleg Vornik sold his entire holding in the company from early 2024. This company has seen its value surging more than 500% this year, being swept up in the meme stock median. You can see right now falling more than 30% or so after the CEO sold more than 49 million Aussie dollars in shares, Avril.
Yeah, Shery, coming up on the Asia Trade, we'll talk investment strategy with Bokeh Capital and Vantage Markets, and the CEO of accounting software provider Xero joins us to break down their earnings. Much more ahead. This is Bloomberg.
The Democrats may have permanently damaged the federal statistical system with October CPI and jobs reports likely never being released. And all of that economic data released will be permanently impaired, leaving our policymakers at the Fed flying blind at a critical period.
White House Press Secretary Caroline Leavitt speaking as the U.S. House votes to reopen the government. Let's get more perspective on markets. And joining us now is Kim Forrest, founder and CIO at Bokeh Capital Partners. Kim, good to have you with us. What does this mean for investors? As the White House Press Secretary just said, we're flying blind at this point.
Well, I'd say we're flying blind-ish, right? We had the good fortune of having earnings season happen during the government shutdown. So if you're a market watcher, you were able to kind of piece together how well not only your companies were doing, but what they are going to do in the future. And that kind of tells you what the economic data probably look like now. So we think there was soft hiring. We can figure that out from Challenger and ADP numbers, not necessarily having the jobs number. Inflation's a little tough to figure out, but again, we don't see it really climbing all that much higher. Again, this is from companies talking to us about, are they going to have to raise prices, or, are margins coming up or down? So we can kind of figure all of this out. So that's the kind of good news. Having data would be great. And I think it's going to be a real challenge for them to get the data out in the next little while, because a lot of it really is hand gathered. People go out and actually ask stores how much they're charging for items.
And yet, how much does all of this matter for investors when markets seem to be looking for any excuse to continue the push higher? We are seeing this incredible rally when it comes to tech stocks and just artificial intelligence investments at this point.
Well, you point out that, AI, we can use it. I think people are really thinking that perhaps jobs are being, jobs are being eliminated so that AI can be used instead. I'm not a believer in that quite yet. I don't think the product is that, 100% reliable, but AI really is the promise of the future, and that's what markets always look for, is something in the future. And my personal thought, though, is it's much longer in the future than most investors are willing to think about, and that's why we're having this crazy high rally right now.
So with that in mind, what is the best way, you think, to play AI?
Well, it's really tough to go against the curve, right? And the curve is going upwards and to the right. So I don't know that I would be adding all that much to AI, although I'd be maybe looking in the future to some things that we can maybe forecast at this point. I think the tremendous push to put all of these data centers up, especially in the middle of the country where we probably won't have power to power them. That's a consideration. So I wouldn't get your hopes up there or invest money there necessarily now. And I also think that a lot of the semiconductor companies still will get orders because as AI gets built out and things are automated, because that's what we really want, our machines to work for us, I think even the kind of lesser chips that aren't part of the AI craze, they might get a boost too. So I still think AI can and should be driving some semiconductor companies right now. But I wouldn't think that today's winners are always going to be the winners either. I don't know if that helps.
It certainly does. But just to pick up on that point a bit further, Kim, I mean, on top of that, it's also this idea that given how concentrated the rally is, that is sapping liquidity in the market. What does that mean for the broader markets?
Sure. Well, I think that does open up some value or some opportunity, let's put it that way, in non-AI stocks. I would be looking for high quality, well, I always am looking for high quality companies regardless of their industry. And I think, if you play a longer game, meaning you're looking at the next 3 to 5 years for your portfolio to grow, it might be a time to add high quality companies that have kind of been left behind because they don't have those two magical letters in them, AI.
Yeah, that's an interesting point, especially as we see the rally in anything AI related at this point. But when it comes to the U.S. government shutdown and just the reopening of the government, we know that consumer sentiment has fallen to a 3-year low. We know that more than 1 million federal workers haven't been paid since October 1st. Will this affect certain sectors of the markets, especially those that are more vulnerable to consumption patterns?
I think it's already happened if it's happening. People are going to get paychecks, and we're going into the relatively soon, fingers crossed that, the government opens in the next day or so and the vote goes through tonight. But we are entering into the holiday season, and even this weekend, we're going to have Black Friday sales. So I don't care what consumer sentiment says. Americans, if they've got $1 in their pocket, or even if they think they're going to get $1 in their pocket, they're going to spend on that credit card and pay it off once they get, money from back pay.
Kim, I wonder then, is this whole shutdown episode a reminder of the policy and government uncertainty that's come out of the U.S. this year? And is that a factor that is pulling capital away from the U.S.?
I think so. I think that, I think you can see that in some of the Treasury auctions, that they have not had a whole lot of participation from outside of the U.S. And that should be a warning for all parts of the U.S. government. We need to work together to make sure that our companies and our government can support people. Right? I mean, that's what we're supposed to do here, is companies employ people, they make great products. It's all supposed to work together. And when one big chunk isn't working, well, it kind of gums everything up. Yeah. Crucial to get back to the business of governing once the shutdown comes to an end. Kim, great to chat. Thank you so much. Kim Forrest is founder and CIO at Bokeh Capital Partners. We have more ahead on the Asia trade. This is Bloomberg. Let's take a look at oil prices, which posted their biggest drop overnight since June. And this is following on from OPEC projecting a global crude surplus
against the backdrop of U.S. production exceeding expectations. And we actually saw a key market gauge. So this is the WTI's nearest time spread, actually briefly trading in contango. So this means the current prices are cheaper than the contracts for delivery. Now, we are already seeing, as we keep a watch on these Asia energy counters, those in Australia sliding. It will be interesting to watch some of the other names that have diverged from crude prices, the likes of Japan's Inpex and China's CNOOC. And I think the conviction from Asia investors that have been betting on this value rally with these stocks, that will really be put to the test today. Some already saying that $55 a barrel on WTI beckons. So that's what we're watching in oil prices. Shery?
Yeah, take a look at other global headlines that we're following as well, Avril. Democrats again pressing President Trump on his ties to convicted sex trafficker Jeffrey Epstein, highlighting emails that suggest the president knew of Epstein's activities. A congressional committee released 20,000 pages of documents, including emails that appear to allege that Trump spent hours in the house with one of Epstein's victims. Trump posted on Truth Social that Democrats are trying to bring up what he calls a hoax to deflect from the government shutdown. Concerns over the UK Prime Minister's leadership have spilled into the open after Keir Starmer's supporters told reporters a top cabinet minister was plotting to replace him. The claims against Health Secretary Wes Streeting have shattered illusions of cabinet unity weeks ahead of a contentious budget. It's also renewing calls for him to fire top aides, including his chief of staff. Russian President Vladimir Putin has signed an order allowing Citigroup to sell its bank in the country. The order says Renaissance Capital will buy the unit but gave no other details about the sale. Firms including Goldman Sachs, Natixis, and ING also agreed to sell their Russian operations earlier this year. India has labeled Monday's deadly explosion near New Delhi's Red Fort as a terrorist incident. At least 8 people were killed and many more injured when a car exploded, setting nearby vehicles on fire. The move adds pressure on Prime Minister Narendra Modi to forcefully respond to the attack, which was the deadliest in the capital since 2011. We continue to watch the latest developments around the U.S. government shutdown. We are still awaiting that U.S. House vote when it comes to that funding package that was just passed by the Senate. The bill will reopen the federal government and fund some agencies. You can see gold at the moment holding steady. We have seen gold and some copper prices, metals advancing. Traders betting that the Fed will need to further ease monetary policy to shore up the economy. Of course, we haven't had much clarity when it comes to the economy in the United States, given the lack of data. Now we're hearing from the White House that the jobs and CPI data for October unlikely to be released due to the shutdown. Now, the White House National Economic Director Kevin Hassett saying that the shutdown could result in some of that economic data never being recorded, making it really difficult to assess the U.S. economy. You can see silver prices at the moment gaining 0.2%. We have seen other moves around haven assets, including the Japanese yen as well, holding steady after we saw those comments coming from the finance minister. We're hearing from Semaphore that the U.S. is now planning to give back pay to federal workers starting Saturday. Remember, more than 1 million federal workers haven't been paid since October 1st. We'll continue to watch the vote ongoing in the U.S. Congress. This is Bloomberg.
I just want to say that we're very optimistic about the vote tally tonight. We think this is going to happen, and we're sorry that it took this long. So Republicans are going to deliver for the people. We're ready to get back to our legislative agenda. We have a very aggressive calendar for the remainder of this year. There'll be some long days and nights here, some long working weeks, but we will get this thing back on track.
House Speaker Mike Johnson speaking to reporters on Capitol Hill. Now, let's take a snapshot of how U.S. assets are faring ahead of the vote and this U.S. government shutdown, which, of course, is the longest ever. We are seeing S&P 500 futures pointing to a bit of decline, but it's overall looking pretty flat across assets. Let's bring in Jeanette Garretty. She's chief economist at Robertson Stephens. Jeanette, always good to have you on the show. First off, I wanted your thoughts because I remember talking to you when this shutdown first began. It is turning out to be a historic one. Talk to us about these underappreciated risks, longer-term implications for the American economy.
I think there are a couple of them. Yes, I do remember that conversation. And this has been, maybe a surprisingly long one. I'm not so sure. There was so much of a divide in Congress before going into this. In that respect, it's not surprising. It's a bit interesting that once again, however, this shutdown, a rather long one, like the last rather long one, is sort of brought to conclusion in part because of travel-related problems. I'm not saying that's all that happened there, but it was beginning to be noticeable to the American public and in a lot of ways. The longer-term impact will be maybe some of what we've been concerned about and some not. So, for example, in this package, because there is an intention to do back pay for federal workers, which at one point was threatened to not be the case. That will allow the Fed, for example, to take the view that this will play out over the slightly longer term, like past shutdowns, meaning whatever near-term economic loss has happened because of this, it will be recovered when those payments are made and people come back to work. So in that sense, it's fine. In a different sense, though, I think we have to be a little bit concerned about this having become just another add-on to already very sour sentiment on the part of the business community and consumers regarding the amount of uncertainty that has occurred this year and how they can plan for the future when almost everybody expects this kind of uncertainty to continue to happen. So I think this is a problem. If people have money, they will spend it, but you see it with businesses sort of expressing caution, saying, well, our earnings are good, but we're going to be very careful about what we plan to do next, specifically in terms of hiring.
Right.
Jeanette, just hold that thought, because I think to your point, we are, of course, seeing how the potential for flight disruptions over the holiday period really spurred politicians along. And that's perhaps coming as a relief to airline executives, including the Delta CEO. Have a listen.
Thanksgiving will be great. We know the importance of Christmas and Thanksgiving and the holidays. That's our Super Bowl. And that's what we rehearse and plan all year long. We're going to be in really good shape for that.
I wonder if you could touch a bit more, Jeanette, on the impact on consumer sentiment going into the holiday period.
Well, the last reading that we got on consumer sentiment, the biggest concern in that reading was what we call the current conditions report. So there are two pieces to that Michigan Consumer Sentiment Survey, one which asks people to look to the future and another which says, are you better off today than you were 6 months ago? It is that portion, the are you better off today portion, that indicated they came in at a record low. Or almost record low. Let's say you have to go back to 2003 to find something the equivalent. And although it is absolutely true that we never see a direct link between those sentiment surveys and consumer spending, I think in this case, because of the current conditions assessment, we're probably going to see a lot of thinking about what am I really buying and how much do I really want to buy. And one factor in that was that as the shutdown in the federal government played out, consumers saw what was going to happen to their health insurance premiums. And that most likely will not play out because some of the provisions of the agreement, but they saw what the threat was, and it was a real eye-opener in terms of premiums going up. So I'm sure they're going to be thinking about that as they go forward.
Because it's really all to do with the psychology, right? And it doesn't help that more than 1 million federal workers have also not been paid since October 1st. And those are also consumers that potentially didn't go out, didn't have a meal, didn't go to restaurants, didn't spend. What are the implications of the lost economic momentum there? And also the fact that it could potentially have implications for just the productivity of the federal government itself.
Well, that productivity of the federal government itself, which is something that might be a bit of a laugh line here in the United States, because people think it's not productive to begin with, but this certainly doesn't help. And going back to your comment about it's all psychology, well, yes, it is, but American consumers are wonderful. If they do have $1 in their pocket, they are going to spend it. We know that. But the real issue, one of the real issues, again, is the impact of all of this, I think, on small and medium-sized businesses. So the airlines will bounce back. One of the damages that was done and will probably continue to play out is the impact of lost travel, canceled travel on smaller businesses in the communities where those people would have traveled to. So restaurants and gift shops and any number of things that are out there. And it's in the small and medium-sized business segment that things have been especially difficult for business owners to manage the ups, downs, sideways, and who knows what of tariffs and everything else this year.
Yeah.
It's a problem.
I was going to say, I mean, we stopped talking about the tariffs, but the impact of that must still be felt in the U.S. economy, especially for those smaller businesses that have had to pay higher prices. What are the long-term consequences of that, and have we seen all of the impact so far from those levies?
Yeah, yes, I do think the impact is cumulative, and we've only seen part of it. And I think the Federal Reserve is getting increasingly worried about that too, that there are some limits to what businesses can do in this environment, and that feeds into their concerns about inflation, maybe something that carries forward a little bit longer than they were anticipating. But another behavior we also see is just businesses of all sorts saying, given all of this, I need to be as lean and mean as possible. I need to be as productive as possible if I can be, but if I can't improve my productivity in some way, then I really have to cut back or be very, very careful about what I plan to spend money on in the next, let's say, 18 months.
Jeanette, on the tariff issue, I wonder if you could also weigh in on whether you are seeing or anticipating shifts in the extent in which the Trump administration will be able to continue pushing forward its economic policy following the Democratic sweep that we saw last week and as the Supreme Court continues its deliberations.
So first, I must say, there are so many pieces to what the administration is doing right now. I would be reluctant to say that I can bring it all together to be a single statement about policy. In the area of tariffs, you may be alluding to the Supreme Court decision that is being awaited as to whether Trump and the White House will be able to go forward in exactly the manner that they have. There's some question about that. I think the expectation is that they will have to change strategy there somewhat. The real impact of the election results a week ago does seem to have been to shift the communication sound bites and shift them more towards affordability, because that is a takeaway that many elected officials are receiving. from those election results. So people very worried about economic affordability and concerns that the tariffs and other things are making that worse. I would like to highlight the fact that some of the biggest hawks on the interest rate side, meaning people who are worried about inflation and thinking about that maybe the Fed should not do another interest rate cut because of the inflation numbers. The biggest hawks there seem to be the Federal Reserve presidents. The presidents get a lot of information about the local market. They have all sorts of reports that come into them from businesses and consumers about the impact of potentially rising prices and what those prices may do. It would seem that they are getting information that concerns them, that there is an escalation of prices that may not have yet been picked up in the data. I think it's a concern. It's not proof, but they're worried about it.
When we look at the Fed and monetary policy into next year, how much are you looking at the composition of the FOMC, given that we've heard about Raphael Bostic now retiring? Of course, we have heard Kevin Hassett saying that if he was given the job as Fed chair, he would take it.
Yeah, that's going to be very interesting. And there is also, in March, there is, this is a technical factor most times, but it's probably going to add something to the whole situation, which is in March, there is a reappointment of all the individual Fed presidents, some of whom sit on the FOMC. So there's going to be a lot of change next year, starting in March, with the composition of key Fed committees, the FOMC being the most important one. And I think the Fed would like to have a reason to move interest rates down a little bit more. I think they're not quite sure that this is really the neutral rate of interest where they are sitting right now. And they know that they can have a positive impact on mortgage rates if they take those kinds of actions, which can be helpful in an environment where the housing market's really suffering from very high housing costs, home construction costs, and home purchase costs. But inflation for all of them is going to continue to be a concern.
Jeanette, I thought it was really interesting, your point earlier about the Fed presidents perhaps having a closer ear to the ground on the realities of how the economy is really doing. This is going to be also interesting as we get a potential data deluge. Can we trust the quality of the data, and how do you think Fed members will be approaching this?
We are going to get a data deluge, except not the data that we really want, right? Because we want October. We're not going to get that. We're going to get other sources. And what's come to the fore once again is something called the Beige Book. Every Federal Reserve president in their region conducts a survey of business conditions that is somewhat colloquial. It's not the same quality data, if you will, as something coming from the BLS or the BEA, but it's important data, and it's become more important data. So I think to the extent that there may be concerns about the quality of the data deluge that we get after the government opens up, and I would be very concerned about it because, quite frankly, people are playing catch up. They're going to have to take some shortcuts to get to where they need to go and catch up on the data. But there are other sources, and I think everybody has shifted. I know I have as an economist to looking at these other sources of data that can illuminate and provide a double check on the quality of the data we're getting from the federal government.
Jeanette Garretty, always good to get your insights. Chief economist at Robertson Stephens, as we continue to follow the nearing of the end of the U.S. government shutdown. This is Bloomberg. Take a look at how currencies are trading at the moment. We are watching the Aussie dollar trading in a narrow range after the RBA deputy governor talked about how monetary policy is only mildly restrictive. We're also following the offshore yuan, which gained ground in the past few sessions against the U.S. dollar. We continue to watch the latest trade developments. The latest that we've heard is China's purchases of American soybeans appear to have stalled. And of course, it's all about the Japanese yen still holding at that 154 level against the U.S. dollar. This coming at a time when we continue to see the downside pressure weakening to the lowest level since February against the U.S. dollar. We heard from the new finance minister talking about these excessive moves in the yen, but the pressure is there, Avril, when it comes to the Japanese currency.
Yeah, we are on the intervention watch, and this is as we watch out as well for the nearing of the end, as you said earlier, for the U.S. government shutdown, but also how traders are positioning for this. They're piling into Treasury options, so betting that the cascade of data will show the U.S. economy is weakening. Of course, we're watching out for updates on the labor market, on inflation, with the U.S. government expected to open. Who better to us than Bloomberg's chief correspondent for FX and rates in Asia, Rhee Carson. So, Rhee, we're seeing bond traders snapping up these Treasury options, and this is already happening after the 10-year yield fell, 5 basis points yesterday? How are they positioning, and what is driving these bullish bets on bonds?
Yeah, absolutely. Treasuries, obviously the risk-free rate of the world, so a lot riding on this. And yes, Treasuries did rally yesterday. We saw the 10-year yield fall about 5 basis points, most in a week. And this kind of points to the fact that people are going, perhaps growth isn't as good as we think, especially when it comes to jobs, inflation in the US. So what do? You bet that Treasuries will indeed rally on expectations that the Fed will cut interest rates in December. So there's certainly a sense that as the shutdown is ending, traders are going to get confirmation, official confirmation, that the economy is weakening. And if that's the case, rate cuts.
When it comes to the U.S. dollar, though, it was pretty choppy, right? Despite the fact that we saw those moves in Treasuries. On the other side of that trade, the Japanese yen very firmly under pressure, 155. What's driving this continuous move down?
Absolutely. You come into the Asian session and one of the first things people will talk about is the yen. For macro traders, it's definitely grabbing attention here. And you're absolutely right, Shery, like in terms of where it's at, 155, lowest since early this year. Investors are just not convinced that the Bank of Japan is going to raise interest rates as quickly as they hope. Now, remember, inflation obviously has been above the BOJ's target now for years. And despite all the jawboning that we are seeing from officials that, hey, the yen should be, we're watching the yen, be careful about dollar yen, investors are confident in nipping at shorts. They are happy to sell Japan's currency still because, again, it's a game of rate differentials, and they're just believing that a BOJ is just not moving quickly enough.
The BOJ really watching those inflation numbers that we're getting right now when it comes to producer prices for the month of October. Gains of 0.4% month on month, which is coming in a little bit above expectations. When it comes to the year-on-year numbers, also growth of 2.7%. This is also above economists' expectations. Of course, we continue to follow the inflation picture, which when it comes to consumer prices has stayed above that 2% target from the BOJ for a few years now, and the producer price factory gate inflation also continuing to accelerate, Avril, and of course this has big implications for the Bank of Japan.
Yeah, and as we watch the Bank of Japan, we're also keeping tabs on its neighboring central bank, the Bokeh, right? We heard from the governor yesterday talking about the financial stability risk and perhaps addressing some of these concerns in relation to the investments that are going into the U.S. from South Korea. Have a listen.
I need to see how this whole uncertainty will go in the future direction. But on the other hand, I say that this is not I have less concern on financial stability-wise because these days the Korean won exchange rate move was mostly dominated by the domestic investment abroad.
And this is coming with a really pressured Korean won. Rhee, I wondered, Are the moves in the Korean currency a bit overdone at this stage?
So this is an interesting question because I asked the same question to the head of trading at a big bank recently, and it was fascinating to hear his answer. The two countries that worries him when it comes to macro trading, Japan and Korea. So obviously we know that one is under a lot of pressure. We know that real estate prices are skyrocketing. At the same time, we're seeing retail investors pump record amounts of money into US shares and US Treasuries. So all this is pressuring the won. And yet we've got a Bank of Korea governor who's saying, you know what, we're watching the data, we're still in an easing cycle. If you're a macro trader looking at this, it just means more won pressure ahead.
Bloomberg's chief correspondent for FX Rates in Asia, Ruth Carson there. And we do have breaking news at the moment. We're hearing from the White House Deputy Press Secretary Kush Desai saying that the Bureau of Labor Statistics isn't refusing to do anything, and he's blaming it on the Democrats for shutting down the government and not allowing the data to be released. And now he's saying that the data, at least for the month of September, will be released after the government reopens. Remember, the White House Press Secretary Leavitt has said that the data for October might not be released because of the shutdown. We have more ahead. This is Bloomberg. Take a look at the setup for markets across Asia as we await the U.S. House vote to end the government shutdown. We're hearing from the White House that we might get that delayed September jobs data, although we had heard earlier from the Press Secretary Leavitt that the jobs data for October is unlikely to be released. Not surprising, of course, for other workers. Perhaps we're not gathering those data points. The market opens in Tokyo is next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens and awaiting the end of the government shutdown in the United States. Congress, the U.S. House voting on that anytime right now, Avril, and of course, what the implications will be for the Federal Reserve as we await those data points from the U.S. economy as well.
Yeah, and it's interesting, ahead of that, markets are kind of already pricing in. And don't forget that the past couple of shutdowns, we've actually seen stocks actually surging following those resolutions. So what we're watching in the session is how much has already been priced in already.
Yeah, because Wall Street continued to rally. We saw the Dow at a record high. We already had seen the topics here in Japan at a record high as well. Take a look at how the Japanese markets are coming online because we had continued to see the downside pressure on the Japanese yen. Remember, we had the finance minister coming in and talking about these excessive moves in the Japanese currency. And of course, we're on the intervention watch. Verbal intervention has happened a few times already from authorities in Japan. And when they will actually get into the markets, the last time that happened was last year in July. The yen at 154 against the U.S. dollars. We're seeing a little bit of downside pressure on the Nikkei, but the topic's continuing to gain ground. We've seen a little bit of that rotation away from those high-flying tech stocks, with SoftBank offloading his NVIDIA stake and really getting into those defensive calls. And the 10-year yield at that 168 level, continue to watch that. We do have a 5-year JGB auction today. We had producer prices out earlier just a few minutes ago, surprising to the upside. And remember, South Korea opening a little bit later today, Avril, because it's a very important day in South Korea where students, they take their college entrance examinations. Suneung, so important for their future.
Yeah, what we do have is the start of cash trading on Treasuries. So take a look at how we are faring. Of course, we saw Treasuries pushing higher already because of the ADP data, and then this expectation that the data deluge coming in supports the case for Fed rate cuts. So that's what's really playing out across assets. I would just highlight what we're seeing in Brent because we are pushing lower at the start of the Asian session as well. You saw WTI in the last hour. it was already hovering towards that $55 handle. And this is after OPEC forecasting crude supplies already exceeding demand, especially when it comes to what the U.S. producers are expected to continue pumping out. So energy and tech is what underperformed. On Wall Street, we're seeing S&P 500 futures pointing a bit lower for the moment, Shery.
Avril, let's discuss what's happening in the U.S., that effort to end the longest ever government shutdown, and bring in our congressional reporter, Eric Watson, who joins us now from D.C. Eric, we actually heard from the House Speaker, Mike Johnson, being pretty confident that the legislation will pass quickly. Where are we at right now?
You know, the bill's coming to a vote before at 9 p.m., certainly in the U.S. time. We're expecting it to pass. Democrats are united in opposition, but Mike Johnson has made some last-minute moves here to ensure that conservatives will be on board, including promising a separate vote to strip out a provision that would essentially allow senators to sue the Justice Department and gain potentially millions of dollars over the January 6th investigation. House conservatives are not happy about that. So it looks like it's on track to pass. And the government will reopen Thursday morning U.S. time. Already, federal workers are getting emails that they need to return to work, and payments are expected to go out over the course of the following week, leading to a rebound in GDP eventually.
Yeah, on that note, what are we likely to see as we count the costs of the impact on the shutdown?
You know, Anna Wong, our economist here in the Washington Bureau, has a really good note out talking about a 1.3 percentage point decrease in fourth quarter GDP, but a full rebound by the spring. But at the end of the day, the government has wasted money here. 650,000 federal workers were furloughed and not working for 43 days, but they will be paid for that work. So that's just straight government waste. I know we've seen these shutdown dramas play out from both parties in the past. The party, in this case, the Democrats, held out in order to try to get an extension of Obamacare, expiring premium tax credits. They didn't succeed. Almost every time the one party tries this, it doesn't work. But again, we see this waste mounting each time it does happen.
And it's really the lack of clarity, Eric, when it comes to economic data to guide the Federal Reserve as well, and economists and investors, right? We heard from the White House that we might get the delayed BLS jobs report from September, but what happens to the October numbers?
Yeah, we won't see October numbers, looks like, ever, and that's going to create a gap in the data as the Fed contemplates further interest rate cuts at the end of the year. This is really a mar on the economic record of the U.S. We'll never really know what happened in October with inflation and jobs, and we were expecting that October jobs report would show a large number of resignations from the federal government under this DOGE effort to buy people out. So, there's going to be a schedule from BLS on a host of, September spending and personal income information, but markets will be eagerly anticipating that in the coming weeks.
Also, I guess worth keeping in mind that we could see another shutdown impending if these issues and disagreements resurface in late January. And this is coming at a time where there are going to be potential shifts in the decision makers on the U.S. Federal Reserve Decision-Making Board. What do we know so far? Because we also heard from the likes of Kevin Hassett that, he would take up the Fed chair post.
Yeah, so most of the government will only be funded to January 30th. Several departments, like the U.S. Department of Agriculture, will be funded until September 30th. So that means things like food stamps, which were suspended amidst legal controversy during this shutdown, would be guaranteed. We're just hearing now from our colleagues at Bloomberg Government, 1 to 3 days for most states to get those benefits out to 41 million Americans who do rely on federal food help. So that won't be an issue in January, but other elements of the government, including the Pentagon, still haven't been funded for the full year. So they could be another battle, potentially again over health care. Democrats were promised a vote in December to extend these expiring tax credits, but we don't expect the House to take that up. And that would lead to a lot of consternation and anger from Democrats. So they could certainly try this tactic again. But having folded under pressure, at least 8 in the Democratic caucus in the Senate having folded, their threat really doesn't carry much weight anymore with the president, I would imagine.
Bloomberg's Eric Watson there joining us from Washington as we continue to watch that U.S. House vote on the government shutdown there. With us now is Hebe Chen, senior market analyst at Vantage Markets. Hebe, I mean, we have seen the markets already rally significantly despite the fact that the government shutdown continues. Even until now, we're expecting that House vote to happen. So what are we expecting the market reaction to be? Will it be a sell the news sort of situation after having bought the rumors already?
Yeah, good morning, Shery. Yes, you're right. I think the market do feel kind of relief rallied just on top of this news that the market, for example, S&P 500 has been up about 1.5% since last Friday. I think you make a good point. What's next, I think, is probably more critical when we're looking into what's going to happen to the market after the U.S. government reopens, which I do feel a little bit concerned as I think the market will have to go through like 3 key steps before the year end. For example, the number one, I think that definitely will be assess the damage that has been done during the past 40 days of shutdown. As mentioned prior to that, it's quite likely that will damage the economy, GDP, from 0.5% to 1%, and that damage is quite tangible. And the number 2 is how that impact the efficiency of the government. I think this morning we already know that we won't get the October data coming through. I think that's quite a strong evidence that damage has been done. Apart from that, I think the market will definitely get ready to digest quite a lot of data coming through. We will have quite condensed and compressed data pack, and that definitely unlikely to be even. So how the investor will digest that complexity that in that. And a bit further down is the trust rebuild. I think, as I mentioned earlier, it's still unlikely that we'll have that welcome that back the government shutdown again in the 2026. How government to convince, how investor to restore the confidence there. I think they're all the big questions that will lie ahead. So after the reopening, I think the real challenge will just begin.
That's a good point. When it comes to the data deluge that you mentioned, of course, very important for what the Federal Reserve does, but also implications for Asia, because when I was speaking to the yen, to the chief currency official here in Japan, Mimura-san, he was talking about how the lack of data when it comes to FX really hampered the visibility even for policymakers across Japan. What are the implications and the fallout from the U.S. government shutdown here across Asia?
Well, yes, I think that's a good point. The visibility is not just to the U.S. government, not just to the Fed. I think it's the global wise. I think most of the central bank, especially for Japanese central bank, they also hanging on the line to whether or not they need to hike. And we can see that the patience for the investor is already running pretty thin, and especially after the political uncertainty for the Japan. So I think they also have the ripple effect. And I think, as you mentioned, it's already been impacted in the other central banks' decisions. Japan is a typical example. I think other Asian banks, central banks will definitely feel that, and they're getting more cautious about their next move before they get more clarity from the Fed.
What the shutdown's also done, I guess, is take attention away from some other really pressing issues. Do you think markets are also perhaps complacent to the tariff risk?
Well, yeah, I think that's a good point. I think that in terms of the shutdown, tariffs, and how they're going to impact the Fed, definitely there's a increasingly sense that whether or not the tariffs impact will be just one time. And we yet so far, because of the blackout, we yet to see that really translate into, for example, the inflation impact, and it hasn't really translated into the economy data. Whether or not that's happening, but because of the data blackout, we yet to see that. That's very likely. So I think as long as we get more the information coming through, we potentially will having a kind of window in October, but definitely we're getting more data from the November data, so we can potentially put in the full picture together to really assess and answer whether or not the tariffs impact into inflation, into the economy is just one time, or it could be last much longer than expected.
I guess it's also worth taking stock as we approach the end of the year. 2025 has been characterized by a lot of volatility, but we are seeing stocks maybe along with Treasuries ending the year higher, dollar down. What do you think the first quarter of next year in terms of cross assets going to look like?
Well, I think as the first point is that whether or not market could restore the confidence coming out from the longest shutdown in history, and whether or not the market do have the confidence that this page has already behind us, because we do see the ramification. I think for one of the very direct one, I think, for example, in the December, the Fed meeting, we get the quarterly the projection for the next year's economy, as well as inflation, as well as the interest rate. Whether or not this shutdown will translate into the real impact into Fed's projection, that will be one of the quite key indicators we're getting to know in 2 months' time, actually less than 2 months' time. So that will definitely pave or lay down the foundation or the sentiment for the market rolling into the 2026. And into the 2026, we don't also have more things that's going to happen, whether or not the US dollar will continue to getting into the lower down because of the debasement trade, because of the loss of credibility. I think they're all the things that have been accumulated in 2025 and potentially will getting even worse into 2026.
Hebe, good to chat. Thank you so much for your analysis. Hebe Chen is Senior Market Analyst at Vantage Markets. And we are seeing Nancy Pelosi speaking on Capitol Hill. Of course, she is set to retire. We're waiting out to see the vote outcome to end the U.S. government shutdown. We have more ahead on the Asia trade. This is Bloomberg. China's purchases of U.S. soybeans appear to have stalled less than 2 weeks after Washington touted a wide-ranging trade truce. Let's bring in our China correspondent Min Min Lo in Hong Kong for us. So there is some uncertainty about the strength of this trade deal, which I guess was always a possibility, given how even at the time there was all this talk about what was being clinched was low-hanging fruit.
Yeah, that's right. And ever since the early shipments that came through just ahead of the trade talk, there has been a lack of visibility over customs data, and traders are saying they're not really seeing any new shipments being ordered of late. So that's raised some uncertainty about just how committed is China to buying those soybeans. And you add to that, there's uncertainty as well, because we know the U.S. White House fact sheet has said that China is committed to buying 12 million metric ton before the end of the year, and there's very little time left. But bear in mind that the Chinese side has never really confirmed the exact amount they were committed to buying. That was all from the US side. You add to that, some of the economic sense just doesn't really add up, because China has already stockpiled a huge amount of soybeans. You can see on the screen there, they bought a lot from Brazil, which means that there isn't that much of a demand shortfall to cover by the end of the year. You add to that as well that US soybeans are trading at a premium to South American beans, plus U.S. soybeans are still subjected to a 13% tariff that is left over from the first trade war, which means that Chinese crushers might be making losses if they were to buy U.S. soybeans. So far, the shipments were mainly from state-owned companies, but commercial buyers have not really made any orders, and analysts are saying that maybe China could be waiting for prices to come down below the Brazilian soybean prices before they might be willing to step in.
I mean, we're also watching the relationship between China and Europe, and now we're hearing that President Macron could be considering inviting Xi Jinping to the G7 summit next year.
Yes, this is according to what sources are saying. Macron might be considering that, and he has already apparently asked his German counterparts about that, and Germany seems to be pretty open as well. But of course, there's still a lot of uncertainty, right? Because it's not clear whether other G7 members would be open to that, especially considering how the G7 over the past few years has been very focused on countering China. A lot of their discussions have been about securing European or the G7 supply chain from any disruptions from Chinese goods, and also they have been focusing on how to end the Ukraine war, and many of these countries still believe that China is a major enabler. And even if Macron is able to pull this off, question is whether President Xi will be willing to go himself, because we can of course expect some pretty tense conversations in France if he were to attend. And bear in mind, Macron is facing a hobbled government in Europe, and he is possibly trying to use this platform as well to fashion himself as a great global statesman, to engineer, a Xi appearance at the G7 meeting and making it more worthwhile for President Trump to travel there as well, especially considering that Trump has given a snub to the G20 summit in South Africa this year.
Yeah, to your point about whether C will even go to Europe, I think, that also comes against the backdrop of these mixed signals that France is giving in pushing for more duties on small parcels from China. How big of a risk is this going to be for Chinese firms?
Yeah, of course, it's going to be a big blow because Chinese firms were already hit by the removal of the de minimis loophole in the U.S. And now the EU is also looking at removing this tariff exemption or customs duties exemption for small parcels worth 150 euros or below. Now, this is originally slated to kick in perhaps in 2028, but France is one of those countries that are trying to insert a last-minute revision to that repeal to try to get it implemented as early as 2026. And bear in mind, most of the parcels going into the EU, small parcels, 91% of them are coming from China. So it's going to be disproportionately bad for all these Chinese retailers and e-commerce players like Temu, Shein, AliExpress, and of course going to further escalate tensions between EU and China when there are already a list of other issues from the Ukraine war to the Nexperia chips company and the rare earth curbs and so on.
Bloomberg China correspondent Min Min Lo there with the latest on really the trade environment right now and what's happening in Europe as well. Take a look at what's happening with futures at the moment. In the overnight session, we're watching French bonds because they led the gains with the political clouds beginning to clear a little bit after months of fiscal uncertainty. We're also watching the euro trading steady at the moment. 115 is the level as we're hearing from sources that the EU is set to propose a plan to the U.S. to implement the next phase of their trade agreement that they reached this summer. According to sources, the plan will focus on areas including tariffs and market access. In fact, the U.S. National Economic Council Director Kevin Hassett now saying that the implementation of President Trump's tariff policy is an ongoing process and more changes will probably be made along the way. Hassett spoke with Bloomberg host and Carlyle Group co-founder David Rubenstein on what he's learned from Trump's tariff strategy.
He has believed in tariffs his whole life. And a lot of people thought that the tariffs would come in and cause a recession and cause inflation, and his intuition was that they wouldn't, and they haven't. And I think that we've learned a lot about how tariffs fit into an optimal fiscal policy because of him, and I would say that would be a great accomplishment as well.
Now, the tariff policy, is it complete? Now, in other words, has he finished negotiating the major deals with the countries he wants to negotiate with, or is it still an ongoing process?
It's an ongoing process. It's an ongoing process. I think that one of the things that people have been talking about just the last few days is, thinking about changing tariffs for foodstuffs and things. And so I think that there are going to be more changes, and there have been really big changes. And then one of the things that people forget about, like prudent policymaking, I'm sure that President Carter would have agreed with this point, is that you do what you think is right, and then you watch what happens, and then when you see things that you need to adjust, you adjust them. And so I would guess that we've made really big changes, and that we'll have to make adjustments now.
Now, the theory behind tariffs, I thought, was to even out the trade balance and to some extent, and maybe raise revenue. But the President has imposed tariffs on countries with which we have a surplus, like Brazil. What's the theory behind imposing a surplus or a tariff on something like Brazil?
The point is that it's really easy to transship. And that if you're going to actually have tariffs have an effect on the U.S. economy, then you need to have kind of a tariff wall around the country. And I could say that that tariff policy is very complicated, and there are a lot of things that we're studying carefully right now in this kind of space. But for example, if you're a foreign importer that traditionally has sent stuff into the U.S., sold into the U.S., then one of the ways you can get around the tariff potentially is you set up a U.S. subsidiary, and then you have your widget and you sell it to the U.S. subsidiary for, say, $100. And then the U.S. subsidiary will pay the tariff or you'll pay the tariff, but either way on $100. But then the subsidiary sells the product in the U.S. for $1,000, and you avoid $900 worth of tariff. And so tariffs, if you want them to have an effect on the economy, you have to really, really look at like how are we really collecting the tariff, and how are we making sure that people aren't transshipping, people aren't funneling things through subsidiaries, and so on. And so I think that that's part of the overall calculus.
National Economic Council Director Kevin Hassett speaking with David Rubenstein, Carlyle co-founder and host of Peer to Peer on Bloomberg Television. We have more ahead on the Asia trade. This is Bloomberg. This is the Asia trade. Here are some top global headlines we're following. Democrats are again pressing President Trump on his ties to convicted sex trafficker Jeffrey Epstein, highlighting emails that suggest the president knew of Epstein's activities. A congressional committee released 20,000 pages of documents, including emails that appear to allege that Trump spent hours in a house with one of Epstein's victims. Trump posted on Truth Social that Democrats are trying to bring up what he calls a hoax to deflect from the government shutdown. Meanwhile, House Speaker Mike Johnson says a vote will happen next week on legislation to compel the Justice Department to release files on Epstein. Now, concerns over the UK Prime Minister's leadership have spilled into the open after Keir Starmer's supporters told reporters a top cabinet minister was plotting to replace him. The claims against Health Secretary Wes Streeting have shattered illusions of cabinet unity weeks ahead of a contentious budget. It's also renewing calls for him to fire top aides, including his chief of staff. Taiwan's government says it's considering using chips export curbs as a diplomatic tool. Foreign Minister Lin Chia-lung says Taipei hopes not to weaponize chips but may act if nations harm its interests. It's a sign that Taiwan has not completely abandoned a tool that it briefly threatened to deploy this year against South Africa. We have more ahead on the Asia trade. This is Bloomberg. Breaking data crossing the terminal. We were watching out for jobs numbers out of Australia, and for the month of October we're seeing jobs growth that is way ahead of expectations. 42.2k versus the expected 20k in terms of jobs growth. The jobless rate is also lower than consensus and lower than the prior reading, so perhaps an improvement in the Australian labour market after a relatively soft picture from the month of September. And you're seeing perhaps a bit of that knee-jerk Aussie dollar to 65 US cents thereabouts. Shery?
Yeah, quite a reaction, because we actually had seen the Aussie pretty range-bound after those comments by the RBA Deputy Governor talking about how monetary policy remained restrictive. But we're also following what's happening in the South Korea market. Remember, they're opening at the top of the hour, which is an hour later than usual. Thousands of students sitting for their college entry exams. Korean won fell against the dollar on Wednesday. We saw foreign outflows resuming from Kospi stocks, the currency trading near the weakest level since the global financial crisis. And at the same time, we saw some moves in 10-year bond futures after the Bank of Korea Governor Lee Chang-yong told us exclusively that the central bank remains in an easing cycle.
From a Bank of Korea's perspective, we don't believe that monetary policy alone can control the housing crisis. But on the other hand, we are mindful that ample liquidity wouldn't throw the fire to the real estate market. We need to coordinate. There are a lot of government policy has to be coordinated, not in the short term, but in longer term perspectives. And I think government is considering new supply policies together with many other policies. So we'll see how it's going to affect. I don't think that it's going to have a very short-term impact on the price itself. But at least I hope to see the slowdown of the rapid increase of the housing prices in metropolitan area.
So rate cuts are still on the table. Some say why? Because when you take a look at GDP, it's come in, higher than expected, and trade looks pretty resilient.
But at this moment, given the negative output gap still, our official position is that we will maintain the easing monetary cycle, but the magnitude and timing of the cut or even the change of direction will depend on the new data that we will see.
Yields have been surging to levels perhaps that suggest that rate cuts are no longer needed, and perhaps even a rate hike may be in the making. Is the bond market, are the bond traders misguided in thinking that?
At this moment, our bond market yield react not only to the domestic factors, but also global factors, such as the possibility of the U.S. Fed decision and also the dollar strength.
If the Fed does cut, does that provide you enough, room to cut your own rates?
In general, definitely the lower interest rate in the United States will give us some more room, leeway for us to have a more independent monetary policy through the exchange rate channel or through the bond market channels too.
Despite that resilience we're seeing in the dollar, there's been a lot of talk about debasement, how people around the world, countries around the world are pulling away from U.S. assets. Do you see debasement happening?
No, actually. I think we have discussed this quite a lot. But actually, if you look at the actual capital flows in the last 6 months, I don't see that there's a lot of talk, but there's no real movement away from dollar.
Bank of Korea Governor Lee Chang-yong speaking exclusively with Bloomberg's Hazinda Amin. We're also watching for Bank of Japan's governor's comments in Parliament right now. Governor Ueda now saying that the BOJ is aiming for stable inflation with gains in wages. The price trend is rising gradually toward the 2% goal. 1 point of pressure for the BOJ could be the weakness of the Japanese yen, which at one point touched that 155 level. We're slightly below that against the U.S. dollar. Nikkei stocks at the moment under pressure, and we're watching JGBs. We do have a 5-year JGB auction, and of course the fiscal concerns are big in this economy and what it could do to long-term yields. Let's bring in Japan economics and government reporter Yoshiaki Nohara. Yoshi, because we got some more indications of where the new prime minister stands when it comes to monetary policy and BOJ.
Right. So what we learned yesterday, late night, was that Takaichi mentioned that the appropriate monetary policy is important for strong growth and price stability. But she didn't say what appropriate means. So meaning that she's learning how to communicate with the market now as a prime minister, giving space for the markets to interpret whatever she means. And people tend to think, of course, because of her background for support of monetary easing. So
was she giving a signal to Governor Ueda to come along with her, or that she's going to give space to the BOJ is the question, right?
Well, that's a good question. But it's it's a tactical way to communicate because, by doing that, she's giving some space to ensure that BOJ has independent space, which is important. But at the same time, she's not, taking away her, pressure on the BOJ because she's not saying that I want to see rate hikes right now. Right?
Yeah. And it's really interesting that we're not seeing perhaps that space also leading to more concerns about the Japanese yen, what the government could do in terms of fiscal policy and also weighing on the yen. And we had the new finance minister also weighing in the markets. We're seeing verbal intervention. When can we see actual intervention, I guess?
I would say there's some distance to actual intervention. But what you need to know is that, if you compare that to how Takaichi was communicating to the BOJ, what Katayama said yesterday about yen was more direct. So you can tell that probably it's fair to assume that the preference of the government may be using the interventions, or at least the verbal interventions, to hold the yen's weakness.
Yeah, I mean, 155. We saw the last intervention, I think, last year at around 160. So what could be next for investors to watch out for?
Well, 160 is obviously a psychological key level, but people have from now, people need to really close attention to each language the finance minister says. There's some lexicon going over there. You have to understand the nuances and urgency she's conveying by speaking up.
To be fair, I mean, that lexicon is pretty boring, right? I mean, excessive moves or, is usually the same with urgency, watching the moves. Yoshiaki Nohara, good to have you with us, Bloomberg's Japan economics reporter here with what to watch out for when it comes to the Japanese markets, Avril.
Yeah, and let's take a look at the U.S. markets as well as we continue watching developments on Capitol Hill that hopefully brings us to the government reopening. And investors already have been betting on how the deluge of data will support the case for Fed rate cuts, even though the White House has indicated that the October jobs and CPI data will unlikely ever be released. We are seeing the continued climb on the U.S. 10-year, so yields are moving higher, or rather I should say that the U.S. 10-year is slipping for the moment, so yields are moving a little higher towards the 409 handle. But Shery, is also really interesting, right, as we watch for these spending plans of governments, as you just highlighted with Yoshi, is that this is affecting a $150 trillion global bond market. And this is also coming at the time where we have entered an era where for investors, they are demanding yields at levels for corporates and seeing that as safer than that of governments. So what we're really seeing is also lower yields being demanded for the likes of Microsoft, for Airbus, than the countries that these companies are from. So it speaks to how since the pandemic era, perhaps corporates have been able to rein in spending, but can't quite say the same for some of these governments, Shery.
Yeah, I mean, it's really interesting because I had this conversation just a few weeks ago with NEC Asset Management, and they were talking about how credit spreads are talked about as being really narrow, that they appear low, and that perhaps is not an accurate description of risk right now because that doesn't count for the fiscal risk premium that we're actually seeing in government bonds. So when comparing corporate bond yields to government bond yields, spreads can look tight, but government bonds now include that fiscal premium, which means that they're no longer entirely risk-free, and that's something that you need to consider. So NEC Asset Management was telling me that they were actually adding, as you said, those very safe bets on corporate debt.
Shery, in the meantime, let's get to some market calls today. The Goldman Sachs strategist who correctly predicted Wall Street's underperformance this year expects U.S. equities to keep lagging for the next decade. Peter Oppenheimer and his team recommended that investors increase diversification beyond the U.S. as elevated stock valuations put a lid on gains. They expect the S&P 500 to achieve annual returns of 6.5% in the coming 10 years, the weakest among all regions. Emerging markets are projected to be strongest at 10.9% a year. The lone analyst with a bearish call on SK Hynix and Samsung says South Korean chip stocks have reached levels where valuations are difficult to justify. Morningstar Sting Jie-yu says that leaves them vulnerable to sharp declines on minor setbacks. Their bearish call was first issued more than a month ago and is now drawing fresh attention as scrutiny grows over tech giants' aggressive spending on AI. He says when expectations are so high, it's very easy to disappoint, Shery.
Yeah, Avril, and we continue to watch the U.S. government shutdown and that vote that we are awaiting at the U.S. House of Representatives to end the longest one on record. And now we're hearing that President Trump plans to sign the bill that is yet to pass the House at 9:45 p.m. Eastern. Now, that's around 2 hours from now, but as I mentioned, that bill still needs to pass the U.S. House in order for President Trump to actually sign it in 2 hours from now. We'll continue bringing you the latest developments there. More ahead. This is Bloomberg.
Let's take a look at how U.S. assets are faring as we approach the outcome of a vote that could end the U.S. government shutdown and finally bring the government back into rebooting and governing. And we are, of course, seeing these live pictures out of Capitol Hill. For the moment, the dollar has been holding pretty steady. It has, in the past session, pretty much struggled to rebound. And this is even though the dollar carry trade seems to have been resurfacing. The 10-year yield holding out at 4.08. We, of course, have been seeing Treasuries mostly climbing this week. And it's really how private data is supporting the case for the Fed to once again in December cut rates, and investors will have to contend with a deluge of data, although indications are now from the White House, well, from the press secretary Caroline Leavitt specifically, that we might not ever get some of the October numbers. September, though, still seems likely to come through for investors to sort of digest. S&P 500 futures pointing to further declines, or that caution is creeping in the Asia session as developments unfold on Capitol Hill. Shery.
Yeah, we're watching Capitol Hill and the Minority Leader Hakeem Jeffries speaking right now as we're waiting that U.S. House vote that President Trump says he will sign in about 2 hours' time once it passes. But as you said, Avril, this is the longest government shutdown on record, 43 days. And it's only temporary funding, right, through the end of January, a compromise that the Senate forged, endorsed by the president, reinstating federal workers fired during the shutdown, guaranteeing back pay for furloughed employees as well. And it will prevent further layoffs. But when it comes to the Democrats, it excludes an extension of the enhanced Obamacare premium tax credits they wanted. So that will be a key point of contention in the weeks to come. This, as the economy, of course, continues to face challenges in the U.S. You mentioned some of that data that we might get delayed from September, perhaps none for October. And this coming at a time when we have seen air travel slowing down, consumer sentiment dropping to a 3-year low. The Congressional Budget Office now saying that shutdown could reduce growth in this year's fourth quarter by about 1.5 percentage points. And the top corporate stories that we're tracking at the moment as we're waiting that U.S. House vote. Anthropic saying it plans to spend $50 billion to build custom data centers for artificial intelligence work in several U.S. locations, including Texas and New York. Is the latest expensive pledge for infrastructure to support the AI boom. The OpenAI rival says the new sites to be developed with UK-based Fluid Stack will start coming online next year. Hon Hai has offered a rosy outlook for the year ahead, pointing to artificial intelligence development as its most important growth driver. That's after it reported a better-than-expected 17% surge in September quarter net income. The assembler of Apple iPhones and other hardware also expressing cautious optimism about a recovery next year in consumer electronics. Toyota has confirmed it will spend as much as $10 billion in the U.S. over the next 5 years to boost its local operations. The announcement comes less than a month after President Trump flagged that the Japanese car maker planned such an investment. Toyota's U.S. sales chief says details on how the money will be spent will be revealed at a later time. Sneaker maker On has lifted its annual sales forecast after strong third quarter demand in Europe and Asia. The Roger Federer-backed brand now sees revenue growing 34% this year, with gross profit margin rising to 62.5%. Its U.S. listed share surged 18% on the upbeat outlook.
Shery, take a look at how we're seeing cross assets in Australia, because we did get stronger than expected jobs data, both in terms of jobs growth and a lower jobless rate. So that perhaps is on the margin affecting the expectations of what the RBA is going to do. So we saw a sharp climb in the Aussie versus the greenback. We already have the likes of the M Life strategists or M Life contributors saying, though, that this Aussie rally against the greenback could stall if you think about getting past the October 1st highs. For help to do that, we will need weak U.S. data. And of course, we are in this data blackout, even though the end of the U.S. government shutdown hopefully draws a change on that. We are seeing Asia stocks in general looking quite tepid. Australia stocks are, of course, lower for the moment. Perhaps that expectation that the RBA will not need to ease as much. We're also seeing a massive move in the 3-year, of course, the more policy-sensitive part of the bond markets in Australia. 11 basis points. That's the rise that we're seeing in the Aussie 3-year yield. As I said, it is relatively cautious across Asia, looking quite flat as well in the markets in Japan. And one tech stock in focus, Shery.
Yeah, SoftBank that continues to lose ground at the moment. And this, of course, after they sold off their stake in NVIDIA. And we saw losses of as much as 10% in the previous session, and really coinciding with those concerns around a potential AI bubble. And given that Masayoshi Son is investing so much around artificial intelligence, those concerns really clouding the outlook for the SoftBank stock, down now 4.5% at the moment, at the lowest level in about a month. We'll continue to bring you the latest developments around the markets. Cautious, as Avril just mentioned. More ahead. This is Bloomberg.
You're watching the Asia Trade. Sydney-listed cloud accounting software company Xero saw a 20% surge in revenue compared to the same period last year on AI optimism and its recent acquisition of US-based Melio. Let's get more on these results with Xero CEO Sukhinder Singh Cassidy. Sukhinder, just quickly first I wonder if we could get your thoughts on what you're seeing among small businesses, because they are sort of impacted by the U.S. government shutdown, and what that potentially means for your projections into next year.
Sure. Well, interestingly, around the world, we're seeing small businesses holding pretty strong. We have data on every market. And if you look at our data on both Australia and New Zealand, and I'll come to the U.S. in a moment, we see sales actually improving in a modest recovery. And in the U.S., the NFIB uncertainty it remains high, but optimism for small businesses also remains at an all-time high. So we see small businesses holding up pretty well despite an uncertain environment.
So tell us a little bit about the U.S. market, because you had the purchase of Melio, and how that could help expanding your market share there, and what some of the challenges could be.
Sure. So the Melio acquisition was really predicated on the idea that we have very strong, easy-to-use accounting software, but what our customers are looking for is a fuller value proposition that includes payments. We have a very strong invoicing product that Melio brings, Bill Pay, which is a very high ARPU, highly used, sticky product for cash flow management. And then the third leg of the stool we always talk about is payroll. And we also integrated Gusto payroll right into the Xero offering. So what do we expect? We expect to really bolster our product in the U.S. with the addition of both Melio and Bill Pay, as well as payroll, and then to be able to drive stronger subscriber growth and ARPU over time with that acquisition, which gives us a lot of confidence. On day one, it also gives us tremendous scale.
It also, though, raises some concerns about the cost burden from this acquisition. What would you say? Is that going to play out in the next year, and does that perhaps affect the potential for big M&As for the company?
Sure. Well, first of all, I would say we were very comfortable with the aspiration we gave around Melio, that we believe that while it'd be not very marginally dilutive in the short term, that we would return to Rule of 40 by FY28 within 2 years of now. So I think we feel quite comfortable that when you are pursuing a high growth market, given the group profitability and Melio's increasing scale, which when combined with our U.S. business offers a really attractive opportunity to get to combined scale, that actually at a group level, we will come back to Rule of 40 profitability. And we, again, if you look at this half's results, showed really nice improvement in our own OPEX, which also gives us more, I would say, dollars to reinvest in growth for the U.S., for Australia, for the U.K., and at the group level. So I think we feel quite comfortable in buying a high growth asset and being able to return to Rule of 40.
Sukhinder, Singh, Cassidy, good to have you with us, CEO of Xero there. And we continue to watch the U.S. government shutdown and that House vote to come anytime now. President Trump saying that he plans to sign it in about 2 hours' time. But we continue to see from the minority leader continuing on that speech whether or not, of course, this will actually lead to a rebound in the U.S. economy after we continue to see the downside pressure from the lack of economic data, also the challenges around more than 1 million federal workers being not paid since October remains a key question. But we'll continue to follow the latest developments in Washington, D.C. as the effort to temporarily restore government funding continues in Congress. That funding would only last through the end of January. That's it from the Asia Trade. Our markets coverage continues. And remember, South Korea coming online as well at the top of the hour. This is Bloomberg.